This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on Counterparty Risk Intermediation. What we've been doing up to this point is spending a lot of good time on identifying the risk, quantifying the risk, and measuring the risk. And we've done a pretty good job of both, breadth and depth in that area. And in our decision making in terms of risk management, we've pretty much came to the conclusion that it's really our responsibility. And this is a good thing, right? We need to take responsibility for our decisions as financial institutions. Well, this chapter brings in the specter of us saying to some other party, hey, you know what? You worry about it. We're doing all this kind of work. It's overwhelming. Why don't you help us out? Now, when we ask that other party to help us out, probably it's a financial institution of some sort, we're going to pay them to come in and help us manage these kinds of risks. Let's go ahead and look at the learning objectives and you'll see what I mean. Identify counterparty risk intermediaries. All right, so we're going to have an intermediary like a central counterparty or a special purpose vehicle or a derivative product company. And the role of these counterparty risk intermediaries are going to help us manage this counterparty risk. To look at the other learning objectives, we're going to describe the risk management process of a central counterparty. And a loss waterfall, I have a couple of slides in there where we're going to try to figure out who pays for the losses. We'll compare bilateral and centrally cleared over-the-counter derivatives markets. And then in the last couple of slides, we'll talk about capital requirements, and then we'll swing back to some value adjustments that we talked about in a previous chapter. Let's go ahead and start with a really simple question here. Notice that there are two parties here, Counterparty 1 and Counterparty 2. And let's just suppose that that's the two of us sitting across from a table, and we want to trade some kind of a derivative contract. Maybe it's an interest rate swap. Maybe it's a structured note. And so what are we doing? We're looking at each other and we're saying, all right, here's this structured note that we want to trade. Maybe there's some fixed income security involved, and maybe the return on the structured note depends on the return on the S&P 500 index. And in order to make an accurate assessment of this counterparty risk, I need to look at all of your financial statements, and you need to look at all of my financial statements. And I need to be able to perfectly process yours, and you need to be able to perfectly process mine. So this transparency leads to a total and complete understanding of the risk profile that each of us is facing. Well, it's a lot easier if we just bring somebody who sits in the middle of the table and talks to you separately and talks to me separately. And of course, we're talking through this intermediary. This is the idea. This is the idea of intermediation and central clearing. So notice down at the first circle point I have, if we're talking about the Chicago Mercantile Exchange or any of these derivative exchange traded institutions, then this intermediation works really, really well because the exchange itself serves as the intermediary. But remember now, and lots of these derivative contracts are traded in the over-the-counter market. And so we need to, try to, we don't want to duplicate, but we want to replicate what goes on in those exchanges so that we can manage this counterparty risk. What we'll do in these next series of slides is take a look at some examples. So the first one is a special purpose vehicle. And I always tell my students and give this example about special purpose vehicles. Let's suppose I'm a financial institution and I have lots of stuff going on the left-hand side of my balance sheet. I make commercial loans, I make home loans, I make personal loans, I make student loans. So I have a whole bunch of stuff on the left-hand side of my balance sheet. And let's just suppose that I'm really, really good at the mortgage loan business. So what I want to do on the right side of my balance sheet is I want to issue a bond. And I want to raise capital so that I can focus on my core successful business segment. Well, the bondholders over here, the potential bondholders, what they're going to do is they're going to look at all of those assets on the left-hand side of my balance sheet, and they're going to make some of the following conclusions. They're going to say, you know what, Jim, you're really good at mortgages, but you stink at commercial lending, and you stink somewhere here, and plus you stink at short-term cash management. So the bondholders are going to charge me a yield to maturity on that bond issue that depends on the entirety of my financial statements. So how do we kind of get around that? Let's suppose that we have the opportunity to create a separate and legal entity. Let's call it a special purpose vehicle. And I put those mortgages into that special purpose vehicle. So I transfer those assets into that SPV. And then that SPV, which is a separate and legal entity, that SPV can issue a bond. Now, who's going to be interested in buying that kind of a bond? Well, those bondholders who are willing to provide me with capital specifically for one part of my left-hand side of the balance sheet. So they're probably going to be able to pay, they're going to be willing to pay a higher price for my bond, thus lowering that yield to maturity or the borrowing cost. And then, of course, because this is a separate legal entity, then if I go bankrupt as the parent, then those assets are tied to that particular bond issue. So that's why it's known as being bankruptcy remote. Now, the financial press has had a field day with these special purpose vehicles, dating all the way back to Enron in 1999 or 2000. And they call this thing, off-balance sheet financing, which makes it sound like we're being secretive and, working in the James Bond secret agent world trying to hide stuff. But you can find these special purpose vehicles and information on these special purpose vehicles inside of the 10K or other places. So it is an off-balance sheet in the sense that it's not on the balance sheet, but it's not off-balance sheet in the sense that we're trying to hide something. Now look at that second circle point I have there. Special purpose vehicles can be used for anything. I mean, if I'm a financial institution, I could take some of my assets, like my desks. I could put all these desks in a special purpose vehicle and try to issue a bond and say to the bondholders, hey, help me provide really nice desks for all of my workers. But that's probably not going to work out too well. So let's swing back to my structured note example. Special purpose vehicles do a really good job of managing this specific risk in the structured note market. And notice the block point in the middle. SPVs transform counterparty risk into legal risk. And this has really been interesting, over the last 20 years or so, in that these SPVs are set up as separate legal entities, but whenever there is a default, then we have to bring in the court system and lawyers and judges. And let me go ahead and scratch my head. Even though that they're set up as bankruptcy remote, judges could come in and say, well, it's not perfect, and therefore the parent is responsible for taking those assets and is able to take those assets and pay off some of the other creditors. So that's why I've written down there, in some jurisdictions, the SPV is viewed more like a business segment instead of a separate legal entity. Notice the bottom. U.S. courts have a history of ruling in favor of consolidation, but UK has been less keen to do so. So here's a vehicle that's designed to do something, but then it's got to be proven in the system of courts. And of course, we watch the courts all the time, Supreme Court and criminal court, and a lot of times you're really not sure what's going to happen in the end. So you make sure, as a good financial institution, that you're aware of transferring this risk, but there are some consequences. Now, the easiest thing we can do is just pick up the phone and call somebody and say, hey, if I can't pay, will you guarantee? So good example is a letter of credit. And I bet you guys know about letters of credit, which are critical in determining and encouraging international trade. The example that I give my students all the time is the following. Let's suppose I'm a California farmer and I have acres and acres of grapes growing on my farm. And one day I get a phone call from a customer in, let's say, Iceland. And this customer says, hey, I hear you have some great grapes. I want to make some wine. Send me, a ton of grapes. Well, this California farmer doesn't really know the Iceland business. And the Iceland business just knows a little bit about the California farmer. So this trade is never going to happen because the Iceland person is not going to send the money initially. And the California farmer is not going to send the grapes initially without any payment or without any guarantee. Because the grapes, they can be stolen during the shipping. They can fall into the water in the Atlantic Ocean during the shipping. I guess they would have Pacific Ocean. How do you get from California to Iceland? Anyway, they could do a plane. They could do all sorts of bad things can happen during that shipment. So the easiest thing is for the Iceland business just to pick up the phone and call bank and say, hey, will you guarantee that I will pay for the grapes when I get them and they're nice and moist and they don't look like raisins, et cetera, et cetera. So then the California farmer is willing to do this. And so this is really the basis of international trade. You can't have international trade without these bank guarantees. Well, of course, the same thing works in the derivatives market. Going back to my structured note example, if I'm a financial institution and I'm issuing this structured note, I can say to some other financial institution probably, and I can say, hey, look, will you sign a letter of credit guaranteeing that I will make all of these payments? Now look at the bottom block point. They introduced the risk of double default. I mean, this is fascinating. So if I default, then you as the bondholder or the owner of this structured note are in trouble, right? But if I default, then you say, wait, I have this guarantee from the Bank of Iceland over here. And what if the Bank of Iceland is defaulting? So you pick up the phone and call me, I'm not answering. And then you get in your boat and you go all the way over to Iceland and the bank is closed. So double default. Now, these DPCs are really fascinating entities because what they do is they work almost like a special purpose vehicle, but this is a separate business that is designed to look like a special purpose vehicle, but the derivative product company uses its own capital. So think about this special purpose vehicle that has these mortgages inside of them as the assets. And then let me, as the DPC, throw in some of my own equity. And so look at that first circle point, eyeing a strong credit rating. So what we're trying to do is we're trying to get a higher level of a rating so that we can lower our borrowing costs. Now, central counterparties are an extremely efficient way to handle this kind of counterparty risk, especially as it relates in the derivatives market. My example that I've used with you guys before, and I'll go ahead and quickly use it again. Remember at the end of one of my favorite movies of all time, Trading Places, when Mortimer and Randolph Duke lose all this money, the bell hits and the president of the exchange comes down to the floor and says to the brothers, you owe us hundreds of millions of dollars. Accounts are settled every day. What was that first slide I had a few moments ago that this works really, really well on organized exchanges. So the challenge then is how do we take that model on an organized exchange which has standardized contracts and all sorts of trading rules and all that kind of stuff to this over-the-counter market which goes all the way throughout the world and is huge. How do we apply that kind of a model to a bigger arena? Well, anybody can act as a central counterparty to guarantee a trade between a buyer and a seller. But in this over-the-counter market, note that the CCP becomes a legal counterparty to each trade. So that's why I have the light blue box in the middle, and then there's a contract with Counterparty 2, and there's a contract with Counterparty 1. I have an acquaintance that I run into every once in a while who works for an insurance company, and his company is the only company in the area that will insure holes in one for golf tournaments and golf outings. And so, during these, brief conversations, this anecdotal evidence is that his company makes a lot of money on insuring these holes in one. So those of you who play golf, you play in a scramble, you get up to a par 3 and it says, if you have a hole in one, you'll win $1 million or whatever, or a car or whatever it is. So his company is the only one in the area that does this, and they make lots and lots of money. What do? They specialize. So what does this have to do with financial risk management stuff? Well, instead of just specializing in something small like golf outings, these monoline insurance companies, they specialize in providing guarantees. And initially, this goes back to, I think, the early 1970s, when a municipality wanted to issue bonds. And what they did is they went to the market, and the bondholder said, sure, we'll lend you the money, but we'll charge you 10% yield to maturity. Let's just suppose that's a high yield in those days. But what the municipality did is they called an insurance company and said, will you guarantee the coupon payments and the principal payment? And so what does that essentially do? That essentially lowers the borrower's yield to maturity. So these wraps, it's like a wrap around a layer of protection of a municipal bond issue, have extended to, of course, they've extended to mortgage-backed securities and CDOs and almost anything else that you can think of. Now let's look at the difference between netting and bilateral clearing here. Look on the left. If we have all the different parties there and they have different contracts between and among each other, boy, that's a lot of stuff going on. Look at all those arrows. But if you take a central counterparty in there, then you only have the arrows going into that CCP, which, remember, is writing separate and unique contracts with each party. So look at the first circle point there. The CCP becomes a buyer to every seller and a seller to every buyer. So that all the parties that are involved in all these derivative trades really don't care what's going on the outer circle, right? They just care what's going on with the central counterparty. Now look at the bottom block point. The CC pair does not bear the net market risk, which of course still applies to all of the different parties. Going back to my structured note, right? What was I doing? I was promising to pay you, maybe some fixed coupon rate like 2% or 3% plus the return on the S&P 500 index. So that market risk, of course, is still out there. Now, if you came up with some rules and some regulations and a system to be able to take this organized exchange clearinghouse model and apply it to the larger arena, you'd probably come up with these things. So let me just go over these kind of quickly. Setting up rules, that makes sense. Closing out all positions of a defaulting clearing member. Let me go back here. So what if the party up in the northeast corner defaults? And notice that if we had that bilateral arrangement, that northeast corner party may default on one or multiple of those trades, well, then all of those they flow right through the central counterparty, which bears this third-party risk, right? This counterparty risk. So how do we handle that? Well, of course, we have to maintain financial resources, right? We can't just be the person in the middle who collects all the money and then is not covered in the event of default. Reminds me of that Seinfeld issue. Remember that Seinfeld episode when Kramer bets some money on a New York Knicks game for Jerry, and Jerry wins. I think it was $3,500, and the bookie comes to Jerry and says, "I don't have any money to pay you," and Jerry makes fun of the bookie. Anyway, so we have to have this system of financial resources to be able to handle defaults. And of course, that probably brings in this concept of margins and a default fund. This is important to help with the mutualization of losses. You know, mutualization, that sounds like a cool word, but here it just means spreading out those losses. Look at the final arrow point I have. Some banks and most end users of these OTC derivatives, they will access the CCP probably through a clearing member and will not become members themselves. Because look, I'm just regular old Jim. I'm a college professor. If I want to go ahead and buy or enter into the structured note market, I'm probably going to do it through a member. Now, what happens if one of these members defaults? So let me go back to this illustration here. Let's focus on the left-hand bilateral illustration. You know, if the northeast corner party defaults, and let's just suppose that it defaults on the southwest corner contract, right? So what happens? There's a default there. Well, the other parties may or may not know about this in these bilateral arrangements. But if we go over to the right-hand illustration, then the central counterparty is going to know about this and probably call a timeout. You know, this is another great sports analogy. When things are going bad on the basketball court or the football court, we can call a timeout. And so that's what happens in that first block point up there. Quickly halts all financial relations with that particular counterparty. So the positions of the defaulted member then are taken up by the other clearing members, right? So we have some maybe defaulting transactions and maybe some non-defaulting transactions. And so what happens is that the CCP makes an announcement and says something like, all right, Jim's defaulting up there and he has these 100 positions. Who wants in? And so if I have a position that is, let's say, in the money, you might be willing to pay for that. But if I have the defaulting position that's way out of the money, maybe you'll be willing to pay 10 cents or 20 cents on the dollar. Now what happens then is that there's this loss waterfall. And so I have a couple of slides here that indicates this loss waterfall, which is pretty similar to the priority of transactions and the priority of default over on the right-hand side of a balance sheet, right? There's somebody who's first in line to get paid and second and third and fourth and fifth. And so that's what this waterfall is here. So let's go through each one of these. All right, so let's suppose that I default. Well, what's the first line of defense if I default? Well, I have an initial margin and maybe a maintenance margin as well. So I'm putting up cash, maybe I'm putting up some treasury securities, or can I go back to previous of my slides? Maybe I'm putting up the Pink Panther diamond as collateral, but I also have contributed to this default fund. So those assets are seized immediately and used to settle the loss. And so notice the middle point in there. Of course, the CCP is going to design margins and defaults and anything else that goes involved in this so that there's a gigantically high level of confidence that this will cover most default scenarios. But suppose instead, you can imagine that if I'm defaulting, I'm that northeast corner and I'm defaulting just on the southwest corner, but I still have open positions with the others. Maybe some are in the money, maybe some are out of the money. You can imagine that my initial margin and maybe my default fund contribution is probably enough to take care of that. But suppose that I stink at all of those trades and that I'm defaulting on all of those simultaneously. All right. So then we have to swing down to part of, now remember, this CCP is in the middle. And so the CCP is required to have its own equity. And so the CCP will say, all right, I will help pay for some of those losses. However, I'm not going to pay for those losses that interfere with my ability to handle my business with all of the other members. So I have a certain amount. If that's not enough, then we mutualize these through all the other members, because remember, all the other members are paying into this default fund. And so I'll look, the CCP will look in there and take a little bit from each one of those. Then the CCP can say to the members, it's still not enough. Jim was so bad in his trades that that you're going to need to put some extra capital into this. And then the final scenario is that the CCP looks to the rest of its capital. And then, of course, the CCP could declare bankruptcy. All right, so if there's a residual loss, even after the central clearing party's equity has been depleted, then, watch this, I love this. Number one, attempt to secure some liquidity support from a well-capitalized entity, such as a central bank. Does that sound like a bailout? But then you can go to the surviving members and say, you know what, in order for us to survive, we need to do all of those other things. If this doesn't happen, then the CCP can fail itself. All right, let's go ahead and have a couple of slides here, 4 of them, to compare bilateral and central clearing. And these slides are pretty much just a summary of what we've been doing here in the last few minutes. All right, so in bilateral markets, the original counterparties transact directly with each other. All right, so they're the arrows going every which way, but with central clearing, there's that middle ground, right? In the bilateral markets, there's a great deal of flexibility in terms of collateral, like my Pink Panther diamond. But with a central counterparty, these collateral acceptance and available assets are probably pretty standardized. They're almost always non-negotiable. So what that means is that you need to put up treasury securities, or you need to put up some AAA rated bond, or you need to put up something that is agreed upon by that CCP. The Pink Panther diamond probably wouldn't qualify, although I guess if I showed up with the Pink Panther diamond, which is priceless, somebody would take it. You could convince somebody to do it. Now, in the bilateral markets, just about any product can be traded. And this makes perfect sense because you and I are sitting across the table from each other, and we can agree to trade in almost any market. You might remember in previous examples, and I'll go ahead and reach here. We had a forward contract with my 12C. In another slide deck, we talked about some kind of a derivative in oil and barrels of oil. And so we could pretty much make something up. If we wanted to trade based on, let's say, a forward contract on the value of my Beatles CD collection, we could probably do that. But with a CCP, the CCP is going to say, you know what, guys, you need to be on your own to do that, because there's not a great market for Beatles CDs. So if you guys want to trade, go do that by yourself. Remember, the CCP in the middle has this separate contract, so what they want to be able to do is sell it to somebody else. Of course, anyone can participate. You and I can sit across the table from each other, but in the central clearing market, then it's probably open to just members who are willing and able to put up margins and contribute to that default fund. Contract netting, this should be obvious here. Bilateral markets trades are not offset and often not netted. But with the CCP in the middle, there's that netting that essentially makes the CCP market neutral. Not always, but essentially. Concentration of risk in a bilateral market, if we're that northeast corner up there, we're going to probably tend to spread out our risk between and among a host of other counterparties so that we don't put all of our eggs into the one Lehman Brothers basket in 2007. But with central counterparties, the focus is more on eliminating risk or reducing risk. I mean, at least reducing risk. And so there's some areas of protection. Now, in bilateral markets, of course, you and I, if we're sitting across the table, we're going to probably have arguments if one of us is losing lots of money to the other. But in the CCP market, this is one of the great things and one of the great learning experiences that this over-the-counter market has learned from its organized exchange counterparty. Now, in the bilateral markets, of course, there's counterparty risk, there's funding risk, and there are capital costs. But in the CCP market, it's probably just the initial margin. So here's a summary of advantages and, yes, disadvantages here. So transparency, offsetting, loss mutualization, efficiency, et cetera, et cetera. So those should make perfect sense. Some disadvantages, and these are disadvantages that we've talked about regularly throughout many of these chapters: moral hazard and adverse selection. Boy, with adverse selection, you're always worried about somebody knowing more than you do. And with moral hazard, you're always worried about somebody behaving in a way that you didn't think they were going to behave. Now, I think this final learning objective takes us back to a previous chapter on these credit value adjustments. And the idea is, remember what I said in this, in the very first slide. I said that we've spent lots of time defining and quantifying and managing exposure. Remember in a previous chapter we had those graphs that look like a humpback whale for expected exposure and potential future exposure. And so I said, after all that work, we look to another entity over there and say, you know what, you take over, you worry about this stuff. I've been driving myself crazy trying to identify and quantify and manage. How about if you come in and help us out? A special purpose vehicle and all those other things that we talked about throughout this slide deck. And so look at my first block point. If the CCPs were to fulfill this role to perfection, there would be no need for that previous chapter. But of course, central clearing does not make these multiple value adjustments irrelevant. So it's important to think of these other entities out here, special purpose vehicles, right? To think of them as part of the process of identifying risk and quantifying risk and managing the risk. And that takes us through this chapter. I think there's one really, really key part of this chapter, and that is not only the identification of these counterparty risk intermediaries, but knowing what their roles are and knowing exactly how these entities reduce risk and how they can help financial institutions in the big picture risk management process.